welcome. So back to our Monday session, and this is in our free group that we have each week, a weekly session where you can ask your questions and we can dive into this topic. Today, I have received quite a lot of questions around the formulation of a business plan and then actually the steps that you need to take in order to make it suitable for investment. So obviously within that stage there's a lot of things going on. You've got the concepts that you're first kind of getting to grips with in the early stages. How do you validate that? And then when you're building out an MVP, what's the best way in order to do that? And then when you're in that process, what do you need to put together so that at the end goal is to, if the end goal is to raise funding, that you've got all the things that you need in order to do it. So I just wanted to lightly in today cover the different stages from the business plan components to the financial modeling, and then finally in the pitch deck, the things that you need to be aware of so that when you're right back at the beginning stage and you're building out your business plan, that you can take some of these things into consideration. So let me just dive in a little bit further here so that you can have a little look. So in terms of validating your business plan, it's really important to make sure that you have tested and you have data that supports your theory. So you've got this great idea, you're thinking about starting a business, and even if you're a bit further down the line, if you haven't done it, you really should go back and validate it if that's something you haven't done. It's no longer really about spending months building something and then launching, because ultimately you'll launch to crickets. What you really need to do is validate and build and test and iterate as you go through that entire process. So first of all, it starts with actually identifying what your problem and solution is, and then making sure that that's the right fit. So validating the pain points, and you can do that in many different ways. Customer interviews, different surveys, creating, how I like to do it is recommend that all the founders build out their sort of a panel of enthusiasts within their niche so they can really interrogate the data and look at what is the problem, what are the solutions, what's currently being filling that gap, and then documenting any of the competitor gaps and analysis through a SWOT analysis. Once you've done that, you've got a really clear idea of what the pain is, what your solution is, and then what are the competitors doing. And it's at that point you need to look a little bit broader to look at market and the total addressable market size and the serviceable market. So you've got a little bit of research around, specifically who can you reach and who are the people that actually would buy that. So there is another video, if this is a question for you, go and check that video out around TAM. It is quite a simple, it's very easy to get it wrong. So lots of founders, when they first start, they actually do get the TAM wrong. So it's worth just checking that video out before proceeding. So do your research, look at some of the research bodies out there, Statista, anything that you can see, Census, some of the competitors, they might have some information on the market size. And then ideally, you're going to have, through the panel research and the interviews and the surveys, you're going to have primary research, which is the data that you've collected, and then secondary data, which is the industry reports. So that's all part of your market validation. And then the next stage is really moving on to your MVP and traction. Now, if you've already jumped ahead and you are now building your MVP without having some of this data, you can go back and start doing that research and gather that, because if you plan on getting investment down the line or very soon, then you need all of that information anyway, and it will help you to really clarify what is it that you're building. Ideally, you do it in the right order, because you don't want to be building something that you don't actually really need and that doesn't actually have that problem solution fit. So you want to start building your MVP, starting getting some traction, look for the evidence of the problem solution fit, and highlight the user metrics that you've got. So you can look at engagement, retention, conversion rates, and also you can also do some different questionnaires and satisfaction research, and then iterate. test, learn, and refine. And if you're thinking your MVP is perfect, it's far too late. You do not need to start with an actual app or a proper solution. You want to be testing the market way before getting to that point where you've got something that is really tangible and close to what you're trying to create. And the whole reason, again, is so that you're validating that you're going down the right path. And then ultimately, do you have the right team? And then building that. So if you're a solo founder, this can still apply to you. It does still apply to you because you need the right development team. If you have to make development, you need the right capabilities in-house with different partners that you can lean on. So this is the point where you need to look at what are your overall needs of the business and make sure that you've got the best possible team to support that and why. And then before kind of moving on, one of the things I like to do is to really tie in this business plan into a spreadsheet. So this is where you can put all of the costs, the development, the testing, the operating expenses, and then build out and define all of the assumptions that you are starting to piece together that will ultimately build out your business model. So then we move on to stage 2, which is the financial modeling in a spreadsheet. So this is the first step, and this is where I would say to start really simply and find a template. And in the group, I've got a few different templates to offer. Just start really simply and outline your assumptions. What do you believe are going to be your revenue drivers? How much do you think it's going to cost you to acquire those consumers? Where are you going to get them? What pricing do you have? What revenue streams are there? How are you going to drive all of those factors? And then ultimately, you can figure out how much does it cost every month to run the business, and therefore how many months do you have, and how much do you need for the different milestones that you want to achieve. Then it's really important to kind of break it down into, what do you need for this stage, for the next stage? How much money do you need to get to revenue? How much money do you need to get to the different points? And then the cash flow, which is actually how much are you burning, and when will you achieve break even? So there's a lot to go into that. There are guidelines in the group, and it's very, very simple. You'll have the basics, which are in all financial plans, pretty much the ongoing cost of running a business, the different legal aspects, different salaries, building your team, customer acquisition costs. All of those components need to go down into a spreadsheet. So eventually this spreadsheet is going to be your business plan. So at some point you can say, okay, if we were to generate or if we were to have some funding or some capital come into the business, we would then deploy that into our marketing channels in this channel, and the conversion rate we anticipate would be this, the customer acquisition cost would be this, and this is what we would see come out of it. So build your spreadsheet, slowly grow it over time, put all of your assumptions in there and all of the different scenarios. And then eventually, when you've got that and you can see what you're forecasting and what your break even would be and what your cash flow is, that's when eventually, when that's all built out, you can then start playing with different scenarios. So you'll have like a base, an optimistic and a pessimistic, and that will then give you a view of if you were to be able to achieve a higher conversion rate or a lower customer acquisition cost or a higher retention rate, all of those different levers, build that out into different scenarios. And then also look for capital efficiency. So if you're going to be driving revenue, how much do you need to get how much of an investment do you need, and what will that create, and is there anything that you can play with, anything that you can change to create more efficiency within the business? What would it be if you were to work with a partner that was able to bring in consumers and you didn't have the customer acquisition costs of a paid search channel, for example? So at this point, you've got your model, you've got your problem, your solution, you've validated the market, that there is a good market for you. You've started to build out your MVP. You're now at the stage where you're modeling what does it actually look like, what will that translate into financially, and then what does that look like down on a spreadsheet. And then ultimately the next stage is, as you're starting to, if you're looking for investment, or if you're looking to bring on team members, have somebody that is putting sweat equity into your business, then having a pitch deck is a useful tool, whether you're going to have funding or not. Personally, I like to have my business plan in a pitch deck supplemented with a spreadsheet. So eventually the spreadsheet is the model that I'm using to in everyday checking the numbers, keeping a track of how I'm progressing, and then the pitch deck is where I would put the strategy. And then ultimately, when I was actually looking to pitch, I would just remove a few slides from this deck of my business plan, the 10 key slides, and use that for investment or for bringing on team members. That's how I personally like to use it, because it reduces having lots of different documents, and I like to see both the visual on slides, so the strategy on the slides, and have the numbers in the spreadsheet. That works really well for me. So it, in terms of actually a pitch deck for the use of raising investment, you only need sort of 10 to 12 core slides, and then the rest you can put into an appendix for answering questions, for giving further detail. So just a quick overview of that, really. It's, you've got the solution development, what it is that you're creating, the problem, the solution, then your validation, how you validated it, how you're going to be generating revenue, the traction and how you're measuring that and how it's progressing, and then that falls into the final financial projection. So really it's this element here, which is problem, data-backed pain points, with all the research that you've got secondary and primary, with the data that you've got from your MVP or from your surveys and questionnaires, and then the solution, your MVP demo, the visuals, the testimonials, the insights, where you've gone out and you've spoken to your ideal customer, then the market, the size and the proof and the competitors, the business model, what does that look like, how are you going to generate revenue, traction, the data that you've got today or your anticipated dates for traction, and then your projections, so the financials. This is where you would take that base spreadsheet and make it into a shareable 3 to 5 year projection with your key assumptions, and then the ask, ultimately based on your bit broader options that you've already gone through in the financial model. You'll know how much money you're looking to raise, how much money that you need, and what that's going to give you. So that ultimately will give you the ask, the funding amount, and the use of funds. So it's at that point then you can integrate all of that data that you've got. You can put it as an appendix with the full research for, should anybody actually ask for that level of data, and that will be your tracking method for, as you expand on your MVP, where you keep your data. Make sure that you're tracking everything, that each month you update it, and ideally that will then feed into the whole process around investor nurturing and sending out this regular contact, regular email to investors to know what it is that you've planned, what it is that you're doing, and the success that you've already achieved well before you actually need or are asking for investment. So the critical validation milestones really are, for pre-MVP, this is where you conduct your discovery interviews, your questionnaires, and you run, whether it's a pre-sales or a wait list campaign, to gauge whether people are actually interested, however you want to validate the problem and solution. Then post-MVP, this is where you can actually look at the data, give it some time, track the retention, the churn, the engagement, the daily active users or the monthly active users, and then validate all the different elements that you would need to for your assumptions that are in your business model. And then investor readiness. So you need to be thinking revenue and how you're going to get there. So this is where you might want to have some discussions with some potential paying customers to say, yes, we have a letter of intent that if we hit this milestone, if we get to this side, if we deliver this, they will then pay pay X for this. So that could be pilot customers, it could be real customers, it could be free customers that have said, I would be paying this once you've established or you've launched. This is the key milestones that you need to kind of think about validating before you get to the point where you've got enough data that's really strong to really convert and have your investment. So I hope that's been a thorough kind of overview. I know a lot of you are in between these stages at the moment. So any questions, feel free to just message them in the group, and I look forward to hearing from you soon. All right, you take care. Bye.